Hello, everyone, and welcome to episode 19 of the Nord Search podcast. Today, I am joined by Gabriele Martinelli, who is the head of European Power Research at formerly known as Refinitiv, and now they're part of the London Stock Exchange data group. So, Gabriele, nice to have you on the podcast. Thank you for coming on.
Thank you, Patrick, for the invitation, and yes, welcome everyone.
So, as we normally do, if you could just, for those who don't know, I'm sure there's some clients that will listen to this, but for those who don't know you, could you introduce yourself and give us a bit of an idea of your background? That'd be awesome.
Absolutely, yes. So I've been working at Refinitiv, which was formerly Thomson Reuters and formerly Point Carbon for 8 years now, and I've been in my current role as head of the European Power Research Team for 3 years right now. And before that, I have a master degree in mathematical engineering and PhD in statistics. So master from the Technical University in Milan and a PhD from the Norwegian Technical University. And after that, I've been working in the oil business for a few years before becoming analyst and then moving up the ladder of the analyst pathway in my current company. So,
Okay,
yeah.
nice, interesting. So starting off as an analyst and then moving into management, which is
Yes. In a quantitative analyst role and then
yeah,
analyst closer to the market and now
yeah.
management role recently. Yes.
Okay, awesome. And your current role now, head of European Power Research, could you tell us a little bit about that and what you're responsible for?
Absolutely. So we are one of the largest data delivery in the commodity space. So we cover several different commodities in Refinitiv LSEG. So in my particular role, I sit on top of nine modelers and analysts covering the different European market from a fundamental point of view. So building supply and demand model. So demand, wind, solar, hydro. So all that part of the power stack and also writing power price models. So on top of that, so short and medium long power price model, both dispatch and more hydro optimization models for the Nordic price region. So in my team, it's a lot of highly STEM skilled people, so with quantitative background, and also
Okay.
some people that have more like market background and cover more the analysis part.
Okay, so you cover both fundamental and quantitative analysis for the
Correct.
European power markets.
That's correct. Yes.
Okay, interesting. In your business, then, do you have like different departments that look into like power, which is your side, gas? Do you
Yes.
cover other things as well?
Yes. All in all, in the commodities research space, we are more than 100 people covering everything from metals, agriculture, to the power and gas and carbon community,
Yeah.
which was the original building block, you can say, all the way to LNG and shipping. So for all of them, we build both. We are data delivery, so we also parse a lot of third-party data, third-party prices from brokers, exchanges, and so on, and also deliver a lot of quantitative data, the fruit of our forecast. So typically these data are, for us, at least in power, they are a lot weather driven. So we work with all the major weather providers, both in Europe
Yeah.
and the US. So ECMWF, DWD, NOAA in the US. And we parse all the weather run and build forecast on top of the main weather runs, mostly numerical weather prediction, but also lately also the new AI weather system that started delivering during this year.
Okay, interesting. So for those who perhaps might not be aware, so what's the big differences between like fundamental analysis and quantitative analysis?
Yeah, so I would say is that in power trading, there needs to be a constant balance between supply and demand. So you
Yeah.
cannot store power or you cannot store large quantities of power. So in that regards, in the power system in Europe, it has become more and more important to study minute by minute. I mean, in this moment, it's not possible to do it minute by minute, but we usually do by hour or by quarter hours, which is where the market is moving soon, as a precise idea of supply and demand. So for doing that, you need quantitative models. You need more and more in Europe quantitative models that can tell you how much power is produced by especially renewable sources, which is the part that you cannot control, the sort of weather-driven part of the system. And this weather-driven part is really becoming predominant in many European countries, starting from Denmark, which is one of the countries which has the largest penetration of wind, all the way to Germany, to Spain and Italy that has more solar, and so on. So introducing a quantitative layer to supply and demand has been more and more important. In our current position, we started with more than 20 years ago by building quantitative model for the Norwegian and Scandinavian power stack, which was one of the first markets which was liberalized in Europe. So back in the late 90s. So that's why my team currently sits mostly in Oslo. And the reason is that, it was one of the first markets which needed quantitative models to forecast, in that case, the hydro generation. So to forecast how much hydro you could store from season to season. And then in the 2010, then it started to be more important to study also wind and solar. So we start developing models, quantitative models for that. So in a way, right now, depending on the use case of our clients, some clients really just are interested in hedging their production. So they care less about in a way having minute by minute model. But some other clients are obviously more aggressive, more risk takers, and then they really need to have very strong quant departments, understand quantitative models, and use that for trading. So in a way, the world in Europe has evolved a lot in that direction, and the volatility increasing and the penetration of renewables is really bringing quantitative analysis to be more and more important in the power and gas space, and especially in the power space.
Yeah, just because of, like you say, the more renewables, the more need for quantitative analysis
Exactly.
because of
The more
the
renewables, the
weather
more you need to
impacts.
quantify that,
Yeah,
because exactly, even a small error in renewables, like I mean, with installed capacity now approaching 100 gigs of wind and 100 gigs of solar,
yeah,
for example, in markets like Germany, even a small error of 5-10% means several gigs of imbalance. So in a way, then you understand immediately that that is an error that goes above every other consideration on traditional
yeah,
thermal stack and so on. So in a way, this is becoming so important that having good quant models that can achieve a few percentage error is really crucial for trading in these markets with high penetration of renewables.
yeah. In terms of like the customers that you have, you mentioned is it both like asset owners and also like prop traders in the market?
Absolutely. So we have had traditionally a very strong customer base made by all the major utilities in Europe. So asset owners,
Yeah,
of course, or both on the supply side and on the demand side. So retailers, also large consumers of electricity and so on. But also we have a strong base of commodities traders. So both large commodities traders, so the like of what you would find in London or in Geneva and so on, or also boutique traders recently. So the like of what you would find, for example, in Denmark in the Aarhus environment. So more interest in really trading the volatility, the intraday market, and so on. And obviously, these different kind of traders have different needs. So
yeah,
some are more focused on the curve. So the large utilities are more focused on trading the curves. So some of them are more start to be more quant driven, but traditionally the risk appetite is a bit lower. So traditionally they are more conservative in their trading and less interested in deep quantitative modeling like the one we could offer sometimes, but they still look at our medium and long-term models because they offer for them a very precious benchmark when it comes to trading the curve. And on the other side, you have more aggressive players on the market, both commodities, large commodities trader, boutique traders, and also recently investment funds, so banks, investment banks that joined that joined the power, gas, and carbon trading recently, prompted by the increasing volatility and by the large possibility for gains. So both in the carbon space and in the power and gas space. And often these ones are building very strong desks, very quantitative driven desks that are very much in demand of quantitative models like the one we are building. So stack models, which don't only forecast prices, but also forecast flows, forecast generation, and have a really rich output that they can use to feed their machine learning or AI kind of models on their side. So different kind of clients, really.
Yeah. So have you seen, because of what you mentioned there, the increased volatility, have you seen a lot more new players enter the market asking for your services?
We definitely have seen that. We definitely have seen a lot of move from traditional traders that are in need of for kind of desktop application to more traders that are in need for feed, for API, just for data to feed their quantitative workflow. So we have seen really a shift of that. Data is still the king in this market. So selling good data, so quality check data, meta tag data. So the data needs to be ready to be consumed by our customers. So they want obviously a certain infrastructure behind the data, which is what we can provide on our side. But that is really becoming the king in this market. Together sometimes with the desktop applications, so they still need chart very deep and complex charting mechanism, because there is still a lot of analysis, technical analysis on some kind of contracts, especially the more longer term and so on. But together with this screen full of ticks and charts, there is a lot of need for data. So this is what we have seen recently, and the market is really going in this direction.
Yeah. So times are good for you right now.
Absolutely.
So you obviously mentioned the importance of data. So for your clients, how do you ensure that your data is of the highest quality?
Well, we do obviously a lot of quality control on kind of third-party data that we onboard to minimize the risk for outliers and so on. And then really it's all about organizing the data in a way that our clients can use the best. So really tagging the data and organizing them into database. So there is a lot of work of data engineering, of really content team behind the work that we do as analysts, which is possible given the large infrastructure that we have and the large competence that we have in the financial system. So serving not only commodities, but also a lot of other asset classes. So in that we are quite lucky because we can leverage a lot of our infrastructure and make it available for all for commodity users. Yeah, in that regard, this is quite important.
Yeah. Okay. And how do you benchmark your quantitative models?
Well, this is a quite interesting topic because we usually obviously benchmark our traditional demand wind and solar model by mean absolute error or mean absolute percentage error. So there is a lot of classical metrics on the market which you can utilize to make sure that you are serving data that are and models that are of good quality, unbiased, constantly updated, and so on. And on top of that, for our price model, we run also internal P&L, so internal profit and loss metrics. So obviously we are not allowed to trade on our own data. I mean, we are kind of unbiased to the market, and we want to remain to be like that. But obviously, in order to give data that can be utilized with good confidence by our customers, we run internal benchmark, internal profit and loss on the analysis and forecast that we make, both in the short term and in the long term. And usually, really, we open our webinar, our outlook, by being quite transparent. So by saying, okay, like we forecasted this in terms of weather, in terms of prices in the last season, and this is the verification of our forecast. So obviously, it's very important to be transparent to the market and to offer the best possible forecast and admit when you are wrong and try to identify the reasons why you have been wrong and try to do better next time. So in that regard, we are quite proud to have a good P&L on most of our medium and also short-term model. I mean, again, you can define by different metrics. For example, for the day ahead, we benchmark against the opening of the market, and then we measure when the spot comes if we were on the right side or the wrong, if we gave the right bullish or bearish signal to the market. and the same for the front month quarter. We benchmark the last day of the month and so on. So in a way, we try to be quite transparent. And models at the end, so it's difficult. So models try to they optimize even more than the market can do. So sometimes the profile that comes out of our models is too flat. Sometimes it's difficult to reach with quantitative models where the market is, because our models are not autoregressive. Our price models, they are purely built fundamentally, so built on the fuel cost of the day before, and utilizing only internal data, so input, so wind, solar demand, net demand, and all the thermal stack, using internal inputs, fruit of years of research. And since they are not regressive or out-regressive in any sort, sometimes it's difficult to reach the levels where the market is. But for us, it's really important to give a good signal to the market. As I said, sometimes they are too flat, but usually we have a good track record also on models that are fairly flat, like our medium price model for the Nordics, which is a stochastic dual dynamic programming kind of model.
Interesting. So you're using that data yourselves as if you were trading it to make sure that you know it's working.
Absolutely.
Yeah.
I mean, this is the ultimate benchmark for us, is to utilize our own models, our own data, and put that into a price model ourselves, where we also give all the inputs to the traders, because obviously our clients sometimes use only part of our input, not only need to use all our data. So usually they have several sources of information, and they use part of our data as an input for their workflows. But yes, utilizing that into a dispatch model ourselves ultimately is the best possible benchmark, and making sure that dispatch model performs well.
Yeah. I bet in recent years you wish you were trading it.
Yes, in 2022 and 2023, we really wished. Yes.
Yeah, I'm sure. But I'm sure your clients found your data very valuable, the models there. I'd be interested to know, like, you mentioned about your model. So which conditions do your models perform best?
Yes, so most of our model are really dispatch model, where we kind of represent the entire power stack. So we really model the net demand, and we try to achieve the power plant, to identify the power plant which will run as a margin on that particular hour, on that particular day, in that particular country. So one of the strengths of our models is that we run the entire Europe together. So we are really able to represent the power system in the way that a single day ahead coupling market sees that. So a kind of euphemia algorithm. So we are able to reproduce the algorithm ourselves. And obviously we try to represent the entire power stack. So in conditions that are not extreme, our models usually perform very well. So, and conditions that are not extreme means where the supply and demand curve is fairly flat or not too steep. Because when it becomes too steep, that was the case, for example, for the beginning of November, there was a couple of days with really low wind, 1 gig or less than 1 gig of wind in Germany. In that case, the residual demand is above 60 gigs, okay? And then you have to utilize the entire thermal stack, and then the curve becomes very steep. And there, even 1 gig difference can make 200-300 euros per megawatt hour different. So we are in a part of the curve that is a bit uncharted territory. And obviously that is difficult to quantify for our models, because you really need to have a perfect representation of all the stack. But I think the nice thing about power market is that I strongly believe that if you add perfect information about the input, then because of the non-storability of power, you can represent the market in a perfect way. So the problem is that our input, which are still one of the best on the market, at least from the feedback that I get from our customers, is not perfect. So at the extremes, when there is very, very high wind, or where there is very, very low wind, at the extreme of the supply and demand curve, then it's difficult to represent with a very high correctness the situation, and there it's easy to make big mistakes. So both where residual demand is too low, so when it drops below, say, 10, 20 gigs negative, and when it's too high, so when it goes above 60 gigs. I'm giving examples for Germany, but I could make examples for any other European country. Yeah.
Yeah, it was like you mentioned, we saw that at the beginning of November.
Yes, we saw that.
Circumstances.
Yes, we saw that on the 6th and 7th of November. We saw a couple of quite extreme day where the wind was extremely low, and then the thermal stack was close to fully utilized in Germany, and there is where the supply curve gets really steep, and that is fairly difficult to model because the bidding behavior of these kind of actors, which are very seldom seen needed in the curve, is quite difficult to represent, and that is really what we are trying to do with our quantitative models.
Yeah. No, it's interesting because I spoke to one of my clients who's a VP of power trading. I think on the 7th, I always ask, how was the markets today? And he said, oh, the markets were very good today. We were on the right
Exactly.
side. So
Exactly.
yeah, I think that must have been what he was referring to.
Exactly. Exactly.
Yeah. Interesting. So like for you then, what is the most difficult parts of building a good stat model?
Yes, the most difficult part is to have very good inputs, definitely. So very good inputs, I mean many different things. So for the non-dispatchable part of the stack, so the wind, solar, and demand, you obviously need to have good models. Not only good physical model, but also good models about how these renewable actors are bidding into the market. And this is also becoming very challenging. I mean, already the behavior of many of these renewable producers has been changing year on year. So you are moving from a world dominated by sort of feed-in tariff that compensate you per megawatt hour no matter where you bid it in, to more kind of complex kind of support schemes. So CFD, two-way CFD, and even PPA, where you don't have all this freedom to bid this energy wherever you want. I mean, you need to be more careful, especially when there are negative prices, because otherwise your income will not be compensated if the spot goes negative. So we already have seen from 2023 to 2024 quite a large change in how these renewable producers are bidding, and we are obviously trying to incorporate that into our models in order to have a realistic representation of negative prices in our stack model. Then there is the thermal part. And for the thermal part, you obviously need to know the fuels, the different efficiencies in the different parts, and also the operation and maintenance cost of different plants in different technology plants in different countries. So all of that is an input, because obviously there is some gas plants which are very efficient and some gas plants which are not efficient, some plants that respond more to prices, some plants that respond more to temperature. So obviously we need to encode all of that into a dispatch model, so separating for example, now that we are in winter, there is a large portion of gas plants which run because they produce power as a byproduct of heat, for example. And obviously that needs to be incorporated because they don't really respond so much to prices, but more to temperature dropping below certain levels. And then there is other parts which are also even more complicated, which are the hydro producers, because the hydro producers, they have completely other kind of mechanisms of bidding, because they can store water in the reservoir. So ideally, you should run forward backward optimization to really capture their behavior, but obviously that is not possible, for example, in case of a short-term model. So what you do is to try to represent this hydro plant and regress that using historical values. I mean, the near past is a good predictor of the near future typically, and so inferring their short-run marginal cost from the near past. So obviously each part of the power stack is represented in a different way, and all of that needs to be combined into a dispatch model to build a good one. So on top of that, there is now a lot of complications in Europe. I mean, complication on the good side created by the flow-based market coupling. I mean, the continental Europe has been running on flow-based now for several years, with very good optimization of the power flows and an increase of welfare, which is ultimately what Acer and what the European Commission aims to, which is a very good thing. And now, since a couple of weeks, also the Nordic countries have been starting to run on flow-based. And obviously, running on flow-based means that instead of optimizing one individual border between two countries, you have to optimize a lot of individual physical lines between two countries. So that creates a further complication into the problem that you are solving, so more equations into the problem that you are solving into a price model. And obviously also for that, you need a very, very good infrastructure for running your price model. But I mean, all the complications are really for the good, for allowing really decarbonization of Europe. So at the end, you optimize the flow, you allow a faster decarbonization of Europe because you are flowing power from the places that have excess of power to the places where there is need of power. So this is really ultimately going in the right direction, even if this makes the problem more complicated for us and for all the traders out there that are trying to simulate this market.
Yeah. So is it getting more complex then?
Yes, it's definitely getting more complex. I mean, this flow base is one of the complication. Then there is the market is going quarter hourly. I mean, there is already quite a strong decision from Acer about that. There is not a go live date, yes, but we all expect in 2025 the market to go live quarter hourly. So this means also longer terms of solution of this optimization. But again, this goes in the right direction because this allowing day ahead market to run quarter hourly means to have less imbalances in the intraday and less stress ultimately on the intraday and on the balancing market. So ultimately less cost for customers. So in a way, the market is definitely becoming more complicated, but is the only way to allow this larger penetration of renewables. I mean, to achieve these targets that the European Union has set in the Repower EU kind of documents and in all the national targets, which are expected to deliver more than 1,200 gigs of renewables in Europe by 2030. So in a way, it all goes in the direction of integrating more renewables and further decarbonizing Europe, which is what we all strive for.
So as it gets more complex, does that change like how you guys work in your team at all?
Absolutely. A lot of the work, I mean, not only in my team, but we also hear from customers, a lot of the work needs to become more automated because it's not possible to follow manually with the work of analysts several of these different inputs which are becoming more granular. I mean, the resolution is increasing and so on. So for this reason, it's more important to quality check our model. We have on our internal side, we have risk measures, model validation, I mean, a quality control that ensure timely delivery of our content every day to customers. And on customer side also, I mean, all the data discussion we had in the beginning of the conversation goes in this direction because with the increased granularity in power market, there is less room for analysts to manually check the different inputs, and there needs to be a constant data flow that is quality checked automatically to ensure that the trading decisions are taken in the best possible way. So definitely there is both on our side and the customer side larger automation. That doesn't mean that analysts are going to disappear. I mean, analysts are still becoming very good, but I see really we see really the shift for all the profiles, for example, in my team, to become more quantitative. So the shift is not because the market is not important, and that's also why in our team we maintain a single team of analysts and modelers, because for becoming a good modeler, you need to know the market and vice versa. But I mean, it's fair to say that most of the people we hire right now in my team, they need to have very good competence, coding competencies, because that is really making a difference. Both on the back end side and also on the front end. I mean, we see also need for developing more complex dashboard using Tableau, using Power BI, using different kind of tools that build dashboard that are more interactive for clients to check and analyze. So definitely, yes, a trend in this direction.
How long have you seen that directional trend take place? Like when did that start to come into focus?
I think we were quite early on there. So definitely, I mean, we have had in our team, in our delivery to customers, quantitative models as one of the main delivery. We have had that for a long time, but a lot of the shift is really becoming in the past 2-3 years. A lot of the shift is happening because of the increased interest in markets like intraday and balancing. So the increased volumes there is really driving a lot of our so a lot of our clients are asking more data to trade better these kind of instruments, which are having double-digit increase year on year. So if you say that the forward markets, for example, have been stagnant in volumes, while other kind of markets like intraday are growing by several terawatt hour every year in Europe. So this is really driving the shift towards more quantitative data. And obviously we are listening that from our clients and we are trying to serve them in the best possible way.
Yeah, awesome. So you mentioned the winter, as we are now in the winter now, months, the all important months for trading.
Yes.
I often hear. Could you have you done some research on the outlook for the winter? Would be good to discuss that.
Absolutely. So for those of us listening that are our clients, we run typically a winter outlook and a summer outlook a couple of times a year, where we
Yeah,
discuss a bit more in details how we take data from our model, but we also interpret them. We study them
yeah,
together with meteorologists in our company and so on. For this particular winter, the trends that are emerging is that, I mean, leaving aside the weather side, which is still very uncertain, I mean, the weather points out to a milder than normal winter, but less mild than last year. At least this was the partial conclusion from the past seasonal outlook. But in
yeah,
terms of power risk, we see definitely quite some large power risk, for example, for countries like Germany, that have had very fast commissioning of base load and also decarbonization will. So we see large winter risk in case of cold and especially calm winters. When it comes to Germany, calm is way more important than cold because of their reliance on wind. So we see on the other side a fairly healthy situation for countries like France that have a hydro balance above normal and also a nuclear stack running very well this year. So obviously, country by country, there is quite a lot of differences, but the weather risks sometimes are underestimated. And for this reason, we always try to give not only average kind of estimate of how the different power contracts will settle, but also P25, P75 bands, and also P10, P90 to capture really the weather risk. And the weather risk is really large. And actually, I mean, we were afraid to be a bit too bullish in the beginning of October when we released our winter outlook. Then these first days without wind in November came and actually proved that actually the power stack in some countries is really running at the limit, and so is very sensitive to days which are particularly calm. Also, and not only because all the weather is correlated through Europe, so there is very hard correlation, for example, between wind in Germany, wind in UK, wind in Denmark, and so on. So the North Sea basin is really correlated. So in a way, it's not possible to efficiently flow power from where there is abundance of power to where there is need, because days that are really tight are tight for everyone. And so quantifying that is really crucial. And this is what we are trying to do in our models by running several countries at the same time. Just to give you an idea, in our continental power model, now we run 25 countries or price areas simultaneously every single day with the closing fuel of the day before. And this has grown immensely in the past years. I mean, there has been focus in our team to prioritize that. We were running only 5 countries until a few years ago, and then realized
right.
that really by modeling all of them together is crucial. All the stack together is crucial to capture the extreme in a very good way. So I was personally leading this initiative in my team, and this has given us a lot of more confidence in the forecast we can deliver. So definitely for the winter, a lot of weather risk on top of the usual geopolitical risk
Yeah,
related to fuels, which we can definitely not rule out, but they are more difficult to quantify. While
yeah.
weather risk is high, and in a way, it's fairly possible to quantify them. And this is really where we invite a customer to better utilize our data.
Okay, interesting. So obviously, big focus on the weather risk, and you mentioned problems may occur with certain countries like Germany if it's calmer in wind or colder than expected. Is that fair to say?
The temperature affects more countries like France or the
Yeah,
Nordics, that is as a residential kind of heating that is
yeah,
running more on electricity. So in a way, for demand spikes, the country to
yeah,
watch is definitely France, and also Scandinavia, of course, more than Germany, where most of the heating demand, in spite of, I mean, there is an increase of heat pumps, of course, but I mean, most of the heating demand is still met by gas. So that is obviously more interesting for the gas analysts, for the gas market. But yeah, I mean, the weather risk is really large. At a monthly resolution, if I don't remember wrong, I mean, it's up to 20-25 gigs difference from running a calm weather conditions to windy weather condition average throughout a month. So 25 gigs different in output average throughout an entire month for
Wow.
Germany alone. So this is the level of risk we are talking about that was really unthinkable until a few years ago. And in a way, this is weather which has already happened and might happen again. So we are not talking about hypothetical things. We are talking about real weather years, real weather conditions, for example, that occurred in 2020, which was very windy. So you probably remember it was a year almost without winter, so very, very windy and mild winter, versus a year like 2010 or 2012, which was one of the coldest in the recent history in Europe, which delivered very cold and really calm. At the moment, there is nothing pointing directly in that direction, but obviously the risk curve it needs to capture that, and our scenarios capture the possibility. I mean, even if unlucky, the possibility for this kind of scenario.
So what does it look like at the moment? Is it similar to last year, like based on
So
what you know
at
so
the
far?
moment, our outlook for Q1 in Germany is fairly bullish, so versus where the market is. Not a lot bullish because last week we have seen the markets increasing, so we are now a
Yeah.
bit closer to where the market is, but still fairly bullish there. While for France, we are neutral. We are actually bearish in the moment we speak. We have been bullish for the past 6 months. Now we became neutral last week and almost bearish now. And that is also very interesting for the traders to study. I mean, because as I said, our models are really fundamentally driven, so they don't see the traded price as input in whatsoever form. And so in a way, what we are saying now is that at the current level of fuels, the risk for France is neutral or almost on the bearish side. And I mean, so the gap there between us and the market has shrinked and shrinked and shrinked until it swapped the last week. And that is per se a very valuable information for our clients because they have the benchmark of a model which is running just on fuel and which is not seeing the traded price in whatsoever form. And really, I believe, I mean, running this kind of analysis in a kind of unbiased way, because the volatility on the market is obviously sometimes very high, that we know, because it also encompasses a number of other reasons which a fundamental stock model doesn't see and obviously should not see. That is what we strongly believe. So comparing that is a very nice metric that we can offer our clients to better trade in an informed way. Then obviously all the risk consideration, as I said in the beginning, is different from company to company. So there are companies that are more risk prone and companies that are more risk averse. And that is a layer that they have to put on top of the estimate that we can give to the market, obviously.
Yeah. Sorry, just clear. So you mentioned France going now from neutral to potentially bearish. Like, what's the reason why you've made that decision?
No, I mean, it was not an intentional
Yeah.
decision. As I said, like the market reacts sometimes a bit too much on the following the spot. So since the
Yeah.
spot has this couple of days of tension, then obviously this was reflected on the forward market. And our take is that sometimes it's reflected too much on the forward market, not necessarily in a very rational way. And this we have seen both both in May, June, when we're coming from a couple of months of restrictions on the flows outside France. Then really the forward market really dropped. Both the front quarter and the CAL dropped immensely there on the perception that France could never export more than 10 gigs, which turned out to be false, because then we have had very many months with very healthy exports out of France. But in a way, sometimes there is this interaction between short-term and medium-term market, which really makes it complicated to evaluate in a honest way. And this is really where we believe that strong quantitative models can really help the traders to separate the signal from the noise, if you want to call it like that. So this is really an important point, I believe.
Yeah. Interesting. So for you, like mentioning about whether it's calm or cold has a big impact. Like, how accurate can you be on the calmness? Like,
Yes,
and what kind
so
with weather forecasting now? Like, how far can they go into like whether it's going to be windy or not?
So this is a very active area of research. So traditionally, I have to say that traders trust a lot now the 15 days weather forecast that is very well established, both from American players and from European players. It's
Yeah.
very established and it's proven, and we have proven also ourselves that there is signal all the way to day 15. So in a way that there is true signal in this kind of forecast. Then I have to say, since a couple of years, the extended forecast has taken more role. So the 46 days forecast has taken a major role. especially, for example, in markets like the gas one, but also also predominantly in power markets, because they are able to anticipate these 2, 3, 4 weeks ahead the trend, and their kind of skill has increased considerably. So we are fully incorporating the 46 days ahead forecast, the sort of medium range forecast, if you want to call it like that, into our model. So the 46-day ahead forecast is fully incorporated in our model. So this comes now every day. So before it used to come a couple of times a week. Now that comes every day. It comes in a quite good resolution, not the same spatial resolution as the near-end forecast, but a quite good spatial resolution. So 0.4 degrees, so a quite good one. And it has a good layer of trust, let's say, so we fully incorporate that risk into our model. Then the more active area of research is this sort of seasonal forecast. So that is the 6-month ahead forecast, which is an area which in Europe, the European Union, the European Commission, and several bodies, both private and public, are working very actively. So all the Met offices in Europe are collaborating in this Copernicus framework, which is really aiming to improve the skill and the quality of this seasonal forecast. When it comes to that, I have to say that I always meet quite some diffidence from traders. I mean, they are not convinced, and we are not convinced either. And not because the weather forecast is not good, but because the weather forecast is intrinsically very difficult. I mean, Europe is a lot more difficult than other areas in the globe to do seasonal or quasi-seasonal forecasts, because it doesn't have the typical seasonal variability that other areas, like more like dominated by wet and rainy versus dry season or monsoon or kind of cyclones have. I mean, Europe is very hard to do that. So on the other side, we in LSEG, we are very lucky because we have a weather team that is working very actively on that. We have several meteorologists in-house that support us and are able to read the seasonal forecast and to interpret them and to offer their interpretation to our clients. So not only using the forecast itself, but using what in weather is called teleconnection. So typically a lot of other indicators like this NAO, there is oscillations, there is several kind of indicators that are collaborating together with the seasonal forecast per se to create a better view of how the next season might look like. And we have had quite good luck with that, or like quite good skill for that in the past 2 seasons. I mean, both past winter and past summer have been predicted quite good by our meteorologists versus the original raw input that we got from the seasonal forecast. So in a way, you need to have very skilled teams. And nowadays, I have to say that many large utilities, they have their own meteorologist, so that they can rely on for this kind of risk. But in a way, we see that as a very active area of research where we all need to do a bit better. But for the moment, after 46 days, what we do is to incorporate the past 30 weather years and to weight them, so to provide a good overview of the risk for the winter. So we don't consider the seasonal forecast as an input for the moment, but we consider that each of the past 30 weather years is equally likely to appear, and then we run our price model on top of each of the weather condition or the capacity factor or the load factor from each of these individually 30 weather years. Obviously, in hourly resolution and fully correlated for the entire Europe. So yes, this is my take on that.
Yeah, and I guess I've had some other conversations around AI for weather research, and AI is having quite a transformative impact, isn't it, on the longer and the shorter forecast accuracy, I believe.
Yes, I mean, AI is really becoming very important. I mean, AI weather forecasts at the moment are mostly deployed on the short term. I mean, and I mean, just if we spoke 6 months from now or 1 year from now, the picture will be totally different, because 1 year behind us, almost nothing existed. I remember the first science paper that Google published on GraphCast was November 2023. So we are talking about 1 year. And now in this year, we have made tremendous progress. And on our side is very interesting area, because these AI weather models have proven to outcompete traditional numerical weather prediction kind of forecasts. So obviously for us, it's important to learn to use them, to incorporate them,
Yeah.
to study under which conditions, again, they work, they perform the best or the worst, and
Yeah.
also indicate our clients how to better utilize them. So I mean, I have to say that this is a very active area of research, both on academic and in industry, and we are following that very closely.
Yeah, absolutely. I think everyone is. So in terms of the outlook for the future, it'd be interesting, like from your side, like do you feel that looking into the next year, 3 years ahead, like do you think things are going to change much when it comes to quantitative modeling in the power markets?
Yeah, I think really the deployment of renewables is changing the power market in a very dramatic way. Also because at the moment this is not fully, not yet, and it will not be fully balanced by storage systems for a while in Europe. I mean, we have very few examples of markets around the world where storage is at the level where it can really shave the peaks in a very effective way. But in Europe, we are still quite far away, even though in many markets there is very good incentive schemes now to deploy not only renewables but also storage systems, both for the day-ahead market, but even more, especially for ancillary markets and intraday and capacity and balancing markets. So in that regard, the power market is changing very rapidly. It's changing because it's becoming quarter hourly, and who knows, it might become 5 minutes sooner than we think. I don't think the interconnection between the different markets are very well captured in nowadays models. I mean, I'm saying this is also
Yeah.
self-criticism. I mean, we are not able to correctly sometimes incorporate in our model some strategic biddings of intraday versus day ahead, for example, which is becoming more and more common and more evident. So obviously also from a market modeling point of view, a stack market dispatch model will have to incorporate a lot of dynamics which we currently start to observe, but they will become more evident in the future. I mean, my example on the bidding of renewables was just one of them, like how
Yeah.
renewables are changing their bidding behavior, but also the thermal are changing the bidding behavior because before thermal were running base load, so they could
Yeah.
run exactly by short run marginal cost. Now they are running 1,000 hours per year or even 500 hours per year. So obviously, I mean, their kind of revenues in those 500 hours needs to be very different than if you have revenues for 4,000 hours per year. So in a way, the bidding behavior of these kind of actors is changing and needs to be fully incorporated by models. AI will for sure help. I mean, I don't think dispatch model will disappear. I think dispatch model will more and more see their output utilized in AI models on top of dispatch models. So I
Yeah.
think the rich output that dispatch model provides, so all the generation of different fuels, the flows, and so on, will contribute to build better AI models. Just the same way that the weather, the great AI models are built on top of great numerical weather prediction because the best
Yeah.
AI models are trained on 40 years of reanalysis data coming from weather prediction. So ultimately, building physical model is not disappearing.
Yeah.
But obviously, AI will add a layer of improvement because it will be able to incorporate patterns which are invisible to human eye, so which are impossible to encode manually, and so it will be really patterns that only AI models will be able to see.
Yeah.
So in that context, it will be very important very important space to watch.
Yeah. Interesting. No, absolutely. I think lots of people agree with that. I'm sure they know AI is going to have some massive changes in the next few years into how things are done in the market. But look, I think that's everything there, Gabriel. So really fascinating conversation. I love learning more about the power market, especially everything when it comes to quantitative, because that's what a lot of my clients are really focusing on now, that quantitative approach. So it's great to get your thoughts on that. And yeah, appreciate your time.
Absolutely. It was very nice to be here, and I look forward to more conversation like this one. Thank you
Yeah,
very much, Patrick.
absolutely. Thanks,
Bye bye.
Gabriel.